Welcome to Sales Tax and More, your go-to resource for all things state tax related. Now here's your host, Michael Fleming.
Hi, Mike Fleming here, founder of Sales Tax and More, and today's co-host of the Sales Tax and More podcast, where we talk about everybody's favorite topic, which is, of course, sales tax. However, today we're going to divert a little bit and talk about income tax. But first, before we do, let me introduce you to my co-host, Ellie Moffat.
Little bait and switch for everybody today, Mike. So, yes, we're going to be talking about income tax. Great to be here. Quick introduction for Sales Tax and More. We are a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So, we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, and more. So if you have questions about our services, please reach out. We would love to hear from you and we would love to work with you. And please, please, please like and subscribe to this podcast as well. So, Mike, what is an income tax and who is responsible for paying it?
Okay, good question. Just to let you know, today we're going to be talking about state income taxes, not federal income taxes. And state income taxes, they're generally going to be net income taxes. There are other types of taxes, but primarily we're going to be talking about net income taxes. And a net income is really another way of saying it's a tax on your profits. So the company is responsible for paying a tax on its profits. Now, the follow-up question to that should be, who does it get paid to? And the way that most states work is they have apportionment formulas, and there's, the sales in the state divided by the sales everywhere, and you get a percentage and apply that to your uh, net income or your profits, and then that is the amount that's used to apply the state's rate to. We're boiling this down way, way low. Or there's a three-factor apportionment factor, and that's usually based on property sales and payroll. But you get an apportionment factor and you multiply that by your overall profits, and then that percentage of the profits is taxed to the state where you may have nexus and have a responsibility, or the state thinks that you should be paying them the tax on that apportioned amount of profits.
All right, thank you so much, Mike. So, how is this different than a sales or a use tax?
Well, it's different in a couple of ways. The first way is sales tax generally has a lot more potential exposure. See, sales tax is being paid on your gross sales. So the number's usually a lot higher. For example, if I have $100,000 in gross sales, but a 10% profit margin, I'm probably talking about $10,000 or so in net income. So an 8% rate on $100,000 is $8,000, but an 8% rate on $10,000 is only $800. So the potential exposure for sales tax is a lot greater than income tax. And that's why a lot of our clients, they concentrate on the sales tax. They want to make sure that they got the sales tax down, um, because that's where their biggest exposure is going to lie. That's where their biggest problems will be. And as they grow, as they, uh, their potential exposure in these other states becomes meaningful, that's when they start taking care of the income tax in those states.
All right, so does income tax affect e-commerce sellers? Are they protected by, we talk a lot about Public Law 86272. What is, yeah, does income tax affect e-commerce sellers as well?
Well, that's really a two-part question. So the answer to does income tax affect e-commerce sellers is our favorite answer. It depends. It depends on the specific facts and circumstances. And are they protected by Public Law 86272? Well, also it depends. It depends on the state. and it depends on their specific facts and circumstances. So let's tackle that first one. If you're an e-commerce seller, a lot of times you're going to have inventory in an Amazon warehouse. Maybe you don't, but if you do, then states will say that, hey, you have a physical presence here and you need to be paying our income tax. California, very, very aggressive. And even though the inventory is in an Amazon warehouse and Amazon's collecting the sales tax, that still can create nexus for income tax. And California is going after so many people, and they're about 2.5 to 3.5 years backed up pretty much at all times. So if you tried to take care of your past exposure, it's going to take you 2 or 3 years before they get to review your returns. Doesn't mean that you don't need to get it taken care of, because the penalties and interest can really start stacking up. But um, it's going to be a process. It's not going to be over tomorrow. So does income tax affect e-commerce sellers? Absolutely. In a state like Hawaii, Hawaii says that if you have um, a substantial nexus for sales tax, you also have a substantial nexus for income tax. And $100,000 is, or 200 transactions, is their thresholds for substantial nexus for both sales tax and income tax. And therefore, there is no protection from Public Law 86272 as they say it. So it's going to be very, very specific as to whether it can impact an e-commerce seller, or if they are protected by Public Law 86272. When it comes to Public Law 86272, is the state following the current guidelines or put out by the MTC, or are they looking at the historical guidelines? Um, right now, there are 23 states that say they're going to adopt the new guidelines, but only less than a handful of states actually have. The protections of Public Law 86272, pretty simple. This is a federal law, and the federal law says if the only activities in a state are solicitation and the orders go outside the state for approval, and they are then approved from, excuse me, we already said that. If they're shipped from outside the state into the state, then the state is not allowed to impose a net income tax on you. Now, there are lots of other types of taxes that may look, smell or feel like an income tax. You're not protected from them, only from a net income tax. And that is the old rules. The problems is the Public Law 86272 was passed in 1959, and we had a manufacturing-based economy back then. We have a service-based economy today. So if you're offering any types of services in addition to, or instead of selling tangible personal property, then you're not protected. When it comes to the example I was talking about earlier, if you have inventory in a warehouse in California and that's only 2% of your sales, you don't say, okay, well, only 2% of my sales are subject to income tax. This is all or nothing protection. So once you pierce the protections of Public Law 86272, you've got to pay all the tax. So very, very limited protections. Now, if all you're doing is selling and you don't have any services whatsoever, you don't have any inventory in the state. I mean, if you're truly a pure economic nexus and it's a state following the old guidelines, then you are protected by Public Law 86272. If it's a state following the new guidelines, like a New Jersey, if you're over $100,000 or 200 transactions, then they say you are not protected by Public Law 86272 if you do one of a list of things. And one of those things is use cookies, and most websites use cookies nowadays. Also, if you do any post-sale customer service, either by email or on your website by chat. So the new guidelines virtually eviscerate the protections of Public Law 86272. So you've got New York, New Jersey, and California came out. They got their wrists slapped because of the way that they implemented. We think that they're going to continue pushing the new uh, the new guidance on Public Law 86272, even though they got their wrists slapped. But yeah, the protections have always been fairly limited, but I think they're going to become a lot more limited in the coming years here.
And I think, Mike, you touched base on this, but I'll give you a chance to expand if you'd like to. But have there or will there be any major changes to Public Law 86272? And I know that you talked about, are people evaluating historically? Are they looking at the current guidelines? But anything else you want to really add to that?
Yeah, and you bring up a point I want to make. There's a great distinction between changes to Public Law 86272 and interpretations of Public Law 86272 in light of Wayfair. What I've been talking about with the states, are they using the new guidance or the old guidance, is the interpretation of Public Law 86272 based upon the impact of Wayfair and what the Supreme Court said in Wayfair. So the Multi-State Tax Commission put out new guidelines, but they're not binding. They're only suggestions on how states can do things. 23 states have said they're going to accept in whole or in part these new guidelines, but they have not done so yet. The law is still the law. That has not changed. Just the interpretation of how the law applies based upon the new environment that we're looking at here. So a couple of things could happen. Congress may step in and they may clarify the law, or the Supreme Court may step in and they may clarify the law. We're just talking about the interpretation of the law by a third party, and the states are saying we believe what the Multi-State Tax Commission, which comes from a quasi-governmental agency itself. It's a compact. So the law itself has not yet changed. The law has been the same, excuse me, since 1959. It's just how we interpret it that is in sway right now. But Congress passed it in 1959 as a temporary law. Maybe they'll finally getting around to making some of it permanent and making some changes while they're at it. I mean, it's been 66 years since they last visited this. And they flat out said, hey, this is temporary till we can get our arms around Nexus, because Nexus is so confusing. We got to get it right. And here we are 66 years later. We still had this antiquated, wasn't great protection back then, really not great protection now, but it's the only thing that we have. So maybe Congress will step in, maybe the Supreme Court will step in, but if they don't, I see more and more states pushing forward with this new guidance from the MTC.
All right. Thank you so much, Mike. And what can businesses do to make sure that they're staying income tax compliant?
Well, again, the states say that you should be compliant from dollar number one. What we say is, just like in sales tax, is just because the state says you should do something does not necessarily mean that it makes good business sense to do so. Um, the uh, the a state like Virginia, they have an economic nexus of $1 when it comes to sales tax. They say any positive apportionment factor, and sales is one of the apportionment factors. So if you have $1 sales, in theory, you could have nexus and be required by Virginia to file an income tax return in Virginia. But you know what? What's the penalty and interest going to be on $1? So I think we need to use common sense when we're looking at this. Just because the state says we should do it, do we need to do it? And, if it's going to leave a mark, if it's going to really hurt, if the state finds you, then by all means, we need to be tax compliant. But if the cost of compliance, in other words, if it costs more to do your taxes than the amount of tax you're going to get paid, Hey, I say let the state come and find you. That's not the answer the states want to hear. They probably give me a hard time when they hear that. However, to me, that just makes better business sense to uh, take care of this when the numbers are material, at least when they're more than the cost of compliance. So that's the first part of that question there is we've got to look at materiality. The second part you said, how can businesses make sure they're staying income tax compliant? Well, number one, staying abreast of which states are applying the old guidance on Public Law 272 and which states are applying the new guidance. And then just like for sales tax, doing an income tax nexus review, whether you do it yourself or whether you hire someone like us to do it. You got to know where your nexus footprint is. Where potentially could you have a responsibility to file income tax? And sometimes that's not all negative because maybe a state where you have nexus has a lower tax rate than the state where you live. And a portion of your profits that's apportioned to this other state are usually removed from your own state. So you could end up paying less money by paying income tax in more states. Now, again, what's the cost of compliance in multiple states? You got to take that into effect. But in general, um, the state is generally tax is generally not paid to two states. There are certain instances where the same tax may be apportioned to both states, depending on how they do their apportionment factors and throwback rules and throwouts and everything else. It gets really, really complicated. But the point I'm trying to get to is it's not always a negative. Sometimes it's an actual positive. And there are firms that do a heck of a lot of tax planning out there when it comes to state income tax to lower your tax burdens. So that's not a big part of our business. We're primarily sales tax, but we do dabble in income tax when our clients require it.
All right. Well, thank you so much, Mike, for your time and answering these questions. And if you're listening and you have sales tax needs, we offer many solutions and services. We also have an entire website full of free resources for you as well. You can reach out to me directly with any questions. My email is emoffat@salestaxandmore.com, and our website is salestaxandmore.com. So thank you so much for listening today, and you can close us out here, Mike.
Okay, thank you everyone for joining us today. And I promise next episode we'll be back to talking about sales tax because I know that's your favorite topic. Hope to see you then. Bye bye.
Thanks for listening. Be sure to hit subscribe and check out all the resources we have out on the web.